Before we start the show, Andy, I'd just like to say a quick thank you to our podcast sponsors this week. Firstly, Fidelity International. For more information about them, please visit fidelity.co.uk/money to the masses. Also, Wealthify. For more information about Wealthify, please visit wealthify.com. And Hargreaves Lansdown. For more information about Hargreaves Lansdown, please visit hl.co.uk. When investing, your capital is at risk, which means it is possible for the value of your investments to go down as well as up.
Hello and welcome to episode 361 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, Andy. It is just come to the end of week 2 of Grow It. So I've been really absorbed in the Grow It campaign that we're pushing at the moment. So for those of you who haven't heard or didn't listen to last week's show, we're doing a campaign about growing your wealth. So we're educating people about investing. So we're assuming you don't know anything about investing. You could actually be an experienced investor, but we're taking you on a journey of educating you through the key parts of investing so you can start your own investing journey. So that was week 2. Next week is week 3. Just to highlight what we covered this week, we covered investing for income versus growth, buying assets directly versus investing via funds, investment platforms, DIY investing versus GSI, get someone in, and active versus passive investing. We even touched upon ethical investing. So go and look at the Instagram feed and check out the highlights where you can find links to all of the different tasks we created for each day. And don't forget, if you've not been part of Grow It yet, it's not too late. Go to the highlight. You can find day 1 and you can start in your own time. Just go through each day sequentially. It is all run via Instagram. You'll be linked through to our website and the tasks you need to complete, most of which are things like listening and watching audio. So you could even do it on the train, for example, and you'll be well on your journey to improving and growing your wealth. So this is all in conjunction with what we did early on in the year with our Own It and Fix It phase of this whole program of trying to give people a way of improving their finances and becoming more financially secure. So I'm really excited about that, Andy. It's been, as I say, all consuming. Next week, just to give you a bit of a sneak preview, we're going to be looking at how to build an investment portfolio or how to choose a off-the-shelf pre-made portfolio that's managed by somebody on your behalf. We also touch upon investing for children, pensions versus EISs, pensions. We start looking at how much you should put in and about consolidating pensions too, as well as touching upon drawdown. These are all topics that we've touched upon in the past on the podcast, but we pull this all together for people. So if you're not part of it, make sure you do go and join in, because it will be something in there for everybody.
Okay, so let's move on to the podcast then. And first of all, let's read out some fantastic reviews that we've received in the week. And the first one comes under the name of Good Guys Wear Black. So not quite sure where that comes from, but you know who you are. I'm a latecomer to this show, but I absolutely love it, especially the weekly market updates. This show has a way of getting you passionate about money and educating you on financial matters. If you don't believe me, listen to episode 355. I promise you'll be hooked. And the next one was from Louise0D. I love to listen to podcasts about personal finance and investing, but after a while they can feel superficial. This is accessible but goes to a greater depth than other fluffier money podcasts and puts money in a global and economical context. I'm a solo parent but a high earner, and I want to know what to do with my money to protect myself and my children in the future. I feel that this podcast arms me with the right knowledge and keeps me on track. Thanks to all the team for what I know must be a lot of work that goes into this. That's really good.
That is good. And I'm so appreciative of people sending in the reviews. If you can leave reviews, they are incredibly motivating for me and the team. And as the last review stated, there is a lot of work that goes into it, but actually the podcast is only part of what we do. I mean, if we had to put a percentage number on it, the podcast shows are probably only about 10% of the work that goes into Money to the Masses because of all the video and written content that we produce every day. So if you enjoy the podcast, make sure you go and sign up to our newsletter that comes out every Sunday that provides links to all the major stories that relate to your finances in the news, including a roundup of the Sunday newspaper money sections. You can do that by going to moneytothemasses.com/newsletter. So there's a whole host of things you can engage with Money to the Masses, including, don't forget, sign up to our Facebook community group as well. So go to facebook.com/groups/Money to the Masses. And actually, go to podcast 352, which is an episode which is all about getting the most from money to the masses and all the things that we do. So thank you to everyone who has written in. So Andy, moving on, I'm going to tell you what's on the show this week. One of the pieces is actually inspired by Grow It. I've realised over the years I've not done anything about VCTs and EISs. So they're venture capital trusts and enterprise investment schemes. Now these are a slightly more specialised type of investment vehicle, but they are part of the armoury of financial planning out there. So I want to touch upon how they work and who may be interested in them. We're then going to jump onto a piece by Laura, who specialises in writing about all forms of credit for money to the masses and also does some of our investment writing too. She's obviously incredibly talented, and she's going to be talking about a couple of credit cards that have hit the market that are quite well timed given everybody's desire to go on holiday, because they allow you to earn Avios points. So she's going to give you the detail on that, because actually, Andy, one of the biggest Google trends in terms of increase has been flight searches in the last week or so, because everybody's talking about wanting to go on holiday. So we'll do a piece on that, which is clearly very positive and upbeat. Many of you perhaps are going to get to go on holiday, and we're going to close off with a piece by you, Andy, which is looking at energy, because it's very topical, but it is very timely, because there's a task in there that everybody who listens to this show needs to do before the end of March.
Great. So I'll save that for the end of the podcast. So we're going to start with VCTs and EISs. We haven't touched on them before. Bit more specialist. Let's explain them then.
So when I used to work in the city and we were providing financial planning solutions to very wealthy people, VCTs and EISs were part of the arsenal of products that would be used by these wealthy individuals. And they aren't exclusive to people who have plenty of money. They are available to anybody, but they are quite a specialist product. And one of their biggest attractions is the tax incentive that they offer. There are a number of them, which I'm going to run through. So let me just start with VCTs, which are venture capital trusts. Now, the way they work, they are essentially an investment company listed on the stock exchange that invests in small UK businesses. And in order to encourage people to invest in small businesses in the UK, the government offers really generous tax benefits to would-be investors, and the tax incentives also reflect the higher risk nature of these investments. Because of the nature of the companies that they invest in, they're normally quite fledgling, so they're normally early stage companies. And each of these VCTs normally invests in between 30 to 70 of these smaller companies. So it's quite a high risk type of investment, and there are eligibility rules that companies have to meet in order to be eligible to be part of a VCT. So for a VCT to invest in a small company and provide that finance that they might need to in order to grow, then they have to meet certain criteria. That is not relevant for this podcast, so you don't need to know the details of that. But from an investor's point of view, there are attractions to these things. So they come with an income tax credit. So basically you get a 30% income tax credit on any investment into a VCT up to an investment value of £200,000. And that's if you invest in a new VCT share offer. So that is incredibly generous. It used to be 40%, but it's now 30%. But you need to have paid at least that much in tax and hold the shares in the VCT for 5 years. The other thing that your shares in this VCT can provide is tax-free dividends in the future. So that is incredibly attractive, a dividend that is tax-free. So as part of a holistic financial planning approach, we used to use these for investors who are incredibly wealthy as a way of providing potentially an income stream later in life that didn't have taxation on it. Because they are obviously wealthy individuals, they would be taxed quite heavily on their pension on income tax. So this was another sort of tool in the toolkit. So just to reiterate, if you invest in shares normally, you get a £2,000 annual allowance. So that's a dividend allowance where you don't pay income tax on that £2,000. But beyond that, you start to pay income tax based on what your marginal rate of income tax is. So if you're a basic rate taxpayer, then you get charged a tax rate of 7.5% on any dividend income above that allowance, 32.5% if you are a higher rate taxpayer. So that's if you're paying a marginal tax rate of 40%. And for people who are additional rate taxpayers, so they pay a 45% income tax rate, then you pay 38.1% on dividend income above that allowance. So I'm not going to go into exactly how the calculation works with personal allowances and dividend allowances, but they are the general numbers. So you can see there's an attraction there from an investment perspective and income generation. You save tax, but not only that when you eventually sell your VCT, there is no capital gains tax. So assuming you've held them for the duration. So that makes them incredibly attractive from a taxation point of view. So to give you more detail on the actual investments themselves, there's normally two types. There's a generalist one, and they typically invest in unquoted companies, and it can be from a range of sectors, and some do actually specialize maybe in particular sectors. And the companies they invest in are young companies typically, but they don't necessarily have to be, and often they're not actually profitable at the point of time when the VCT invests in them. But there are some VCTs that might invest in slightly more mature businesses. There are VCTs that invest in AIM stocks, so they focus on companies on AIM, so they are listed, which means that they can be very volatile as they are easily bought and sold in the open market. And that's unlike unquoted stocks because the valuations are done periodically. But then equally unquoted stocks, as we all know, there's a liquidity issue there because there is an inability to trade them frequently with people in the open market. So with a VCT, often they're time limited as well. So it could be that the manager of the VCT winds these things up and might buy the shares back at the end of 5 years, or it could be that they give you capital back at the end of 5 years. So the way it works is that the investments are meant to be held for a period of time, but they have incredible tax incentives on the way in, as I've just described, which are particularly attractive to those who are paying high levels of tax or trying to mitigate tax. But the aim from an economy and from a business perspective is to try and get wealthy people to provide finance and invest into smaller companies. Now, EISs are enterprise investment schemes, and they are very similar to VCTs, but they were originally aimed at investing into one company rather than like 30 to 70 companies or just a few. Now, they also offer that incredible 30% income tax relief on any investment, and that is obviously a tax relief on your income tax relating to the current tax year. Once again, any capital gain is CGT free, but there are differences between EISs and VCTs. So, for example, there is no tax-free dividends from EISs, and the upper limit for contributions, rather than being £200,000 every year, it's £1 million, but there is a £2 million limit if the VCT invests in knowledge-intensive companies. So there are subtle differences, but there are more differences between EISs and VCTs, which I'm going to quickly run through. They offer this interesting carryback tax relief, so you can claim 30% tax relief against the previous tax year. They also can be used to defer tax liabilities for gains available within 3 previous years and the upcoming 12 months. And now where that's interesting, there could be somebody, for example, who sells a property that might be liable to taxation, a second property, where they can reinvest the money into an EIS to try and defer that tax liability. So again, the incentive is the taxation, but it's trying to get people to reinvest into these smaller size companies. And you can potentially get 100% inheritance tax relief through business relief if you hold them for 2 years. So you can already tell from listening to what I'm saying, there's an income tax benefit, there's a capital gains tax benefit, there's an inheritance tax benefit relating to EISs. And not only that, EISs offer something called loss relief. And the way that works is that if the value of your investment when it's sold has fallen below what is called the effective cost rate, so if I take an example of you investing £100,000, given the upfront income tax relief, take that £30,000 off, that's the 30%. The effective cost was £70,000. Now, if, for example, the value of that investment fell to zero, then the effective loss for which relief is available is £70,000. So if you use that in conjunction with the income tax relief, that is very attractive for particularly a 45% taxpayer. Now, I've not done the numbers, but I've seen it quoted that if you use that loss relief in conjunction with the income tax relief, then it can almost give you a 61.5% tax relief for a 45% rate income taxpayer. So that is quite incredible. So you can see from my description, the two things have similarities, but there are distinct differences in them. It's, for example, the EIS doesn't have that income tax relief on dividends, and you could argue that they are less liquid because there are those AIM style VCTs which can therefore be a little bit more liquid. So why would anybody use these? Because they are quite an esoteric type of investment, and they are specialist investments. So I would just say to anybody listening to this who's hearing all those tax reliefs, they're sitting there thinking this sounds quite attractive. Always seek financial advice, because there are limited offerings of each of these things that come up, and you need to have advice into whether they are suitable for you as an investor, because I say they are incredibly volatile and high risk. But for somebody who has utilized all of their, say, ISA allowances and annual allowances in terms of pension contributions, these start to become attractive, and particularly because of the tax reliefs that are available. So if you are somebody, for example, who is keen to get a tax-free income going forward, and you're interested in that income tax relief because you're paying a lot of income tax at the moment, a VCT is very attractive. If, on the other hand, you're somebody who would quite like to defer a capital gains tax payment and you want to minimize potential inheritance tax, and you quite like this idea of share loss relief, so that gives you some additional relief based on the fact if the value of these plummet significantly, then EISs would be more attractive. And there's an argument that they provide a greater range of tax planning opportunities. And now, where you can see this leads to is that wealthy people will be attracted to this kind of thing. Now, interestingly, the review earlier on today mentioned the podcast episode 355, and that was the episode where I talked about the difference between the rich and the poor. And I was highlighting inequality, but I also highlighted the way that wealthy people approach investments and wealth. And one of the things they do is obviously invest in assets to accrue wealth, but the other thing is they try and avoid paying tax. And so you can see how this VCTs and EISs become attractive to people who are wealthy, who want to mitigate taxation in terms of capital gains, inheritance, and income tax. And so they're tools that financial advisors will use for their clients. I just want to reiterate that if these things interest you in any way, because you might fall into that bracket of potentially using your allowances, you and your partner, for example, may have used your allowances in terms of ISAs and pensions, then do speak to a financial advisor, as they may be able to recommend either of these investments and whether they are even suitable for your circumstances. Now, it just worth reiterating as well that in order to benefit from the tax reliefs that I've talked about, you do have to hold these things for stated periods of time. So for the EIS, it's 3 years, and for the VCTs, if you recall, I was talking about the 5-year time frame. But that is the sort of detail that you'd be made aware of if you were going to invest in these via a financial advisor.
Okay, so this sounds interesting. I've been listening a lot about the tax benefits here, and it seems to me that that's kind of the main focus. And it made me think about, does that blur the lines in terms of, is this your accountant's responsibility to highlight these kind of things, or is it purely your financial advisor, or both? Where does it start?
Again, going back to that podcast that I mentioned, I created an analogy, if you remember, that was based upon a rich person and somebody who wasn't rich, that was on a lower income, sitting in a room. And I visualized the idea that the wealthy person was surrounded by their accountant and financial advisors who were helping them manage their wealth and maintain it and grow it. And that is usually how these things work, that a financial advisor will highlight the opportunity, but there will be a conversation obviously with their accountants, because they obviously need to know the level of taxation that they pay. And so it will usually be a joint conversation, but the recommendation will come from a financial advisor. So I think it's also interesting that you point out about the taxation seems to be the main benefit. And there was always a phrase that I remember hearing, that you shouldn't let the taxation tail wag the dog. It was the idea that taxation shouldn't be the thing that is actually driving what's going on. It's the result or the benefit of that investment, but it isn't the only reason why you do it, because again, these are high risk investments. But ultimately, from my personal experience, this is the reason why people tend to focus on these, because they are mitigating tax and they provide those opportunities to have another, for example, in a VCT case, income stream that doesn't require taxation, and that is attractive. But of course, there is the volatility aspect as well over time. So if you imagine if you get to retirement from a planning perspective and you've got a huge portfolio of ISAs that don't have taxation when you withdraw for them, your pension, yes, you're going to pay income tax when you start withdrawing from that. But if you had a portfolio of things like VCTs, then you could get dividend income from that doesn't have taxation. And so what happens with wealthy people, again, going back to that podcast I mentioned, I talk about how they mitigate tax throughout their life. It's not just on the way in, it's on the way out as well. And this can be part of the sort of package of tools that financial planners do use. So it's just a very broad overview that I've given to you on these two types of investment, and we'll link through to the official guidance on them on the .gov UK website so you can read more about them yourself.
Okay, so let's welcome Laura back to the show, who's going to be talking about credit cards in the aftermath of the announcement from the government where they've lifted all of the travel restrictions that existed around COVID. So Laura, what are we talking about today?
Yeah, that's right. So the last remaining travel restrictions have now completely been removed. And we're definitely noticing a pickup in the number of people thinking about holidays. I mean, certainly in the office, we've all been kind of fantasizing about actually maybe getting away this year and flying abroad. So with that in mind, I think people are once again thinking about earning bonus points, earning Avios, for example, with British Airways, and trying to figure out the best way to do that, how to maximize the points that they can earn and whether they can, in fact, get free flights or upgrades and just generally the best way to do that.
Okay, so I must admit, I'm fairly new to credit card rewards. I never really took any notice of these things, and I actually use a cashback credit card. And in the last couple of years, I've earned a fair few £100 back as cashback. But obviously, as you say, there are other ways you can earn those rewards. And I have to say, probably Avios points are very, very popular. Obviously, with COVID, they kind of fell out of fashion a little bit, but now they're back. And so, Laura, you're going to give us a kind of basic rundown on what's available at the moment and the kind of rewards you can get.
So we've actually seen two new cards launch in this space recently, both of them from Barclaycard. So we've got the Barclaycard Avios credit card and we've got Barclaycard Avios Plus. And they're in essence very similar to two cards that are already in existence, both from American Express. What they allow you to do is to earn Avios for every pound that you spend on the card, which can then be redeemed against flights. They can be used for hotels and they can also be used for car hire as well. So just to run you through the details for those new cards. So the Barclaycard Avios card has no fee attached to it. It's fee free and you've got the potential to earn 5,000 bonus Avios if you spend £1,000 in the first 3 months of card membership, and you earn at a rate of 1 Avios for every pound you spend. Interestingly, there's also the option to earn a cabin upgrade when you use this card if you spend £20,000 in the first year. So that weighs up very similarly to the British Airways American Express card, which has pretty much the same key features. So it doesn't have a fee. Again, there's 5,000 bonus Avios if you spend £1,000 in the first 3 months, the same earn rate. But the difference between the two is that with the British Airways American Express version, you earn a companion voucher, which can give you a free economy flight. And you only need to spend £12,000 a year on the card rather than the $20,000 with the Barclaycard version. Looking at the Premier or like the premium version of those cards, so we have the Barclaycard Avios Plus and the British Airways American Express Premium Plus. And the key difference here is the American Express version has quite a high annual fee of £250 per calendar year, while the Avios card comes in slightly lower at £240 a year. But with both of the cards, you can earn 25,000 bonus Avios, which, to put into context, is enough to get you a flight somewhere in Europe, maybe somewhere like Milan or Barcelona. And in order to get that 25,000 bonus Avios, you need to spend £3,000 in the first 3 months. And you get a slightly higher earn rate on both of these cards, so 1.5 Avios for every pound you spend. And again, there's the option of either getting a cabin upgrade, so you could go from economy to premium or to business or even first class with the Barclaycard version if you spend £10,000 a year, while with the American Express Premium Plus card, you can get a companion voucher and you only need to spend £10,000 on the card in a year to be eligible for that. The other option, if you're looking to fly with an airline other than British Airways, is to look at the American Express Preferred Rewards card, because you can earn points with that and then you can actually redeem those against a number of different airline loyalty schemes. So all of the big hitters, Virgin, Qatar Airways, Emirates, etc. Also, you may want to look at the Virgin Atlantic Reward credit card or the Virgin Atlantic Rewards Plus credit cards, both of which can be redeemed against either flights or upgrades. So there are a lot of options out there. We've got an article on the site which sums up the best Air Miles credit cards. So if this is something that you're interested in, check that out. And also, it's just worth adding that as with all of these rewards or cashback credit cards, you need to be mindful of being responsible and sensible with your spending on the card and not to overspend in order to qualify for these kinds of rewards. It's just common sense, really. But yeah, the usual advice on these things, make sure that you're paying it off in full each month so you're not attracting a high level of interest. I mean, with some of these cards, for example, the British Airways American Express Premium Plus card, you're looking at 101.4% APR. So it's something that you really need to be mindful of before you start spending excessively on it.
Yeah, absolutely. I mean, since I moved my daily spending over to effectively just everything goes on the credit card that will allow it. Slightly annoying with American Express, actually, because not everywhere takes it. But everything I can put on it, I do. And then I just set up the direct debit to take everything out every month, regardless of what I spend on there. And that makes sure that I don't have to pay any of that APR. But every Christmas, I get a nice little bonus, and it means, you know, I'm earning money for just my normal spending. That's how you should sort of approach these things.
Yeah, and if you're a frequent flyer, these could work out to be quite valuable rewards. So yeah, it's worth just weighing up whether you're going to be spending enough on the card, just doing your normal day-to-day spending to earn the rewards that are on offer.
Okay, so that's a nice little roundup of the latest couple of cards that have come out, on very well timed, actually, for what's happening with the travel restrictions. And that article that Laura mentioned there, we'll put details of that in the podcast notes as usual, and that will be updated if there's any changes going forward. Okay, Laura, thanks ever so much for covering those credit cards in detail, actually. And I'm looking forward to maybe using one of those myself and getting away. Damien, let's bring you back in.
Yeah, so the next part of the podcast, Andy's going to go on and do a piece about energy, which is very relevant and timely because obviously we all know we're getting emails and messages from our energy providers and we're all recoiling in horror at the level of direct debits that we're now going to be forced to pay, or our potential bills. I mean, it's unheard of to have WhatsApp messages coming from your friends, and I'm talking to guys I've known since I was at school, saying, have you heard from your energy company yet? Seen the size of my bill has gone up to X, whatever it might be. That is being felt across the country. So there's something Andy's going to talk about now regarding that, because even when I was at the football the other day, my daughter's football match, somebody come up and asked me about what should I do about my energy bill.
Okay, so I hate to bring doom and gloom to the end of the podcast, but hopefully there's a takeaway here that we can all do, and it actually might save some money. So as you no doubt know already, the price cap increase is in place. That's going to come into force from the 1st of April. That's not news to anyone now. We're kind of getting used to that. And it means that the average bill will go up from £1,277 up to £1,971. So that's an increase of about £700. And I need to stress, that's the average bill. That's not what it will go up by. Some people it will be less, some people it will be more. It's based on your own usage, but you need to be aware it's a big hike that's going to happen to everyone's bills across the board. Now, there are measures in place where you'll get certain credits. We've covered that again in other podcasts, through your council tax bill and also through your energy bill later on in the year. But I'm here today to talk about what you need to be doing this week. Okay, so that price cap increase is in force from the 1st of April. What you need to do, and you do all definitely need to do this because it will save you money, is to grab your app or however you manage your energy usage, and you need to take a meter reading as close to, if not on, the 31st of March, because that is the date that you are locking in your old rate.
So what you mean by that is that you make sure the energy you've used in the lead up to March the 31st is being charged on the old price cap and not the new one. So they don't somehow estimate your usage. They know the correct usage apportionment between the old price cap and the new one.
Exactly, because there's always this kind of period whereby every so often you'll get notified, oh, it's time for your meter reading. Well, don't wait for that, because there's no incentive from the energy firms side of things to send that out exactly on the 31st. In fact, they probably won't. It's down to you to kind of take that initiative.
Yeah, and don't forget that I'm hoping the weather picks up. So you will likely have used more energy in the lead up to the 31st of March than you will do from April. So that apportionment, you do want that to be correct.
And so there's one thing I need to say is that there are a lot of people that will be doing this. And so it's predicted that the energy firms are going to be inundated. I mean, there are 22 million households that are effectively going to be doing this over the next week or so. And so websites might crash, and you might find that you can't actually get online and actually submit your reading on the 31st. What you do need to do, though, is make sure that you've got proof of what your meter reading was on the 31st. Now, this can be as simple as taking a photo on your mobile phone, but you need to be able to prove the date that that was taken on. That can be done through the biometrics on your phone and things like that, but just ensure that you can prove the date that that was taken.
Yeah, and of course, there's nothing to stop you submitting a whole series of meter readings in the lead up anyway. You could almost do them every day in the lead up just to make sure you get one in there. And I suppose this is one of the times when a smart meter is actually pretty useful, because they should be monitoring your usage anyway in that lead up. I just like the idea, Andy, of 20 odd million people disappearing under their cupboard on the same day, like something out of Harry Potter.
It's almost ironic that energy firms have been spending years and years and years desperately telling people, please do a meter reading, because it makes their lives easier. They don't want to overcharge or undercharge. They just want to know what the reading is. And yet we're all going to be doing that for the first time ever. We're all doing it in sync. One quick thing on this before we move on is, if you use a prepayment meter, so not a smart meter, a prepayment meter which you can load up, it's been confirmed that you will be able to effectively stack up your credit. So do take advantage. If you've got spare money, check with your provider to make sure that the rate you're getting pre-1st of April is on the old pre-energy price cap increase rates. I mean, you won't be using as much gas after the 1st of April anyway, but the more you can put on it, the longer it's going to last, right?
Yeah, I think that's a good tip. So I think that's us done for this week, Andy.
Oh, no, hold on. Before we move on from the subject of energy, the first energy provider, Octopus, has actually come out and said that they're going to offer a fixed tariff that will actually work out £48 a year cheaper than the new price cap.
So I see what they've done there, actually. They've just snuck in there to presumably acquire quite a few customers on that because it's marginally cheaper. That's what's interesting. Going forward, hopefully we're going to start seeing some new tariffs come out that will start to mean there's more competition and people aren't just relying on the energy price cap to provide the most cost-effective rate for their energy at home. So can I say, are we done now?
We're definitely done now.
We're definitely done now. So as ever, please leave a review for the podcast. It would be fantastic. Don't forget to join our Facebook community group and also engage with Grow It. I'm doing Instagram lives at 1 p.m. on a Friday during this period. But do you know what? I am toying with the idea of doing regular weekly lives to allow people to chat to us, and I'm even toying with the idea of doing something around midweek markets that might be live. But if people are interested in doing that, then do let me know. You can put a comment in the Facebook group or email me, Damien@moneytothemasses.com, or Andy at moneytothemasses.com, because I am enjoying the live stuff that we do, and I can't get out there just yet to do live shows, but this is the next best thing.
Okay, and that's it. So until next time.
Until next time.